Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome Chris Larsen. Hi, Chris.
Mike, good to see you.
Thank you very much for coming on the podcast. Chris is a founder and principal of the Next Level Income, and he has been in real estate investing for over 20 years. He's been syndicating multifamily deals since 2016. He's got over $1 billion of real estate acquisitions, and he's got some unique investment specialties like car washes. So, but before we do that, would you be so kind as to tell us a little bit about Chris? Where do you live? Your family, kids, cats, pets, wives, dogs, whatever works for you.
I love the plural of everything, including the wives, Mike. That's terrific. But
well, past wife, current wife.
That's right.
I don't know. Sometimes people are married to divorce.
Well, I'm fortunate that that's a fairly boring area of my life. I only have one wife, but we live in Asheville, North Carolina. My wife and I, we have two young boys, 11 and soon to be 13. Here, we've been here for it'll be 15 years, Mike. So yeah, this is definitely home to us and our family. Very fortunate to live in a beautiful area of the country. Love to mountain bike in the area, and we run Next Level Income here, where we get to focus on commercial real estate acquisitions here in the Southeast.
That's awesome. You're blessed, and
Indeed,
it's a great area. I live in a big city. It's a very different experience,
which is also awesome.
Yeah, different flavors, different joys and pleasures. I'm sure you have quite a bit of less traffic than we have here in New York City.
That's for sure. Yeah, I lived in DC for 5 years, and I will tell you what, when it takes you 3 hours to get home in traffic, when it should take 30 minutes, you definitely you appreciate what traffic really is, for sure.
That's right. All right. So without further ado, let's jump into real estate.
Yeah.
So we are recording this in early 2023. Lots of concerns, lots of fears, lots of uncertainty. What's going to happen? We're going into an economic recession. How do you think it's going to impact your investments, what you've done in the multifamily space, car washes, and please volunteer any additional information, what else you'd like to invest into.
Yeah, absolutely.
Yeah, what else has worked for you, and how do you think it's going to be impacted by this cycle?
Yeah, so Mike, our investment thesis revolves around value-add real estate. So, our number one goal is to preserve capital. Number two is to create income for our investors. Number three is to create growth, and that's all wrapped in a tax efficiency, hopefully with respect to all that. So, I mean, I'm not really telling anybody anything they don't know at this point. Obviously, rising rates are impacting short-term cash flows with respect to real estate. It's certainly made it much more challenging for us in terms of acquisition, specifically on the multifamily side, the self-storage side, which is our two primary asset classes, because sellers don't want to come to grips kind of with the fact that they're going to have to accept less money if they want to make the deals work for a purchaser. On the purchasing side, the acquisition side, if we're looking at a deal, we're probably going to get a higher interest rate than we were a year or two ago, and it's probably going to be a lower LTV. So that means that more equity is going to be brought to the deal. So higher interest, more equity, less cash to go around for more investors. So that's going to change the profile of some of these deals, certainly. So we looked at probably 50% more deals last year than the year before, and we made less acquisitions. So that kind of gives you, it's a real simple, way to look at things right now. So you got to kiss a lot more frogs to find a good deal. We are looking at other asset classes, Mike. We have been looking at other asset classes. So multifamily is what I wrote my book about, which I'm happy to share with how people can get a copy of that a little bit later. Self-storage, two, nice stalwart, stable asset classes. But what do you do when returns, are a little bit lower? So I think one of the things you can do is you can look at other assets, other investments that may provide opportunities for higher cash flow and higher potential returns. Car washes is one of those businesses, and I will say business because there is a real estate component for sure, but you can weave in some car wash investments into, say, a portfolio of multifamily and self-storage. You can boost your overall returns, and you can kind of help to increase the returns that may be going down, or maybe just diversify a little bit out of some of the stuff that you have.
Yeah, that's a good point. So I appreciate all that explanation. Everything you said makes total sense. Transaction volume has dropped substantially in commercial and residential real estate, 30 to 40%, good portion of last year, and things are even projected to be worse at the start of this year.
Yeah,
simply because the bid and the ask has widened, and like you said, sellers don't want to capitulate, and the buyers don't want to pay the price that sellers want, simply because cash on cash has got a lot worse. So it becomes a game of waiting, a game of who is going to capitulate first.
Yeah.
But going back to the car wash,
sure.
It is, especially if you buy a car wash with real estate, and there are other real estate businesses that are part operating, part real estate, and this is a great point that you brought. So examples would be, for example, some senior living facilities are part operating businesses.
Absolutely.
You could have some mobile home parks also part operating businesses, and the operating component in many ways is even more important than real estate. So folks need to understand that they are investing in the strength of the operators a lot more than they're investing in the location of the real estate. Great
point. And actually, that's exactly what I call it. I call it operating real estate, Mike. And I would also include short-term rentals in that as well. And I think these are all areas that are also good opportunities if you're on the maybe the less tenured side. If you have some time and expertise in one of these areas, short-term rentals, senior housing, operating experience on a car wash, or any of these other real businesses, right, that have a real estate component, you can earn higher returns because there's more opportunities, there's more levers that you can pull. But you made a really, really good point, Mike, which is the operating team is of utmost importance in those. And one of the things that is very challenging in all of those asset classes is that, unlike multifamily property, which it's pretty easy to go and find a property manager, usually in a bigger city, bigger MSA, there's multiple options for a good property manager. Maybe not a great one, but there's good ones out there, and you have to kind of sort through those to find the great ones. But sometimes it's hard to find any operators for these assets when it comes to car washes, when it comes to assisted living or senior housing. So in our case, we had to build an operating team for the car washes. And so it's not as simple as just buying something and plugging in a property manager. Sometimes you have to come with everything to the table.
Yeah, that's a great point. Phenomenal point. I've heard this story before, even with senior living facilities.
Yeah.
They try to outsource it, and then the operator runs into the ground, and then the owners have to get their act together and start operating themselves.
Yeah.
But the car wash,
absolutely.
So how are you investing? Do you have a fund that invests in the car wash? Or I'm just curious, how have you structured that whole business? Because you have to come in, and you have to come in with management. So you have to have vertical integration and the expertise in that field. And then you're buying, I assume, these locations in a given city or cities, because you need to have some economy of scale.
That's right. Yeah. So let's take a quick step back and ask the question, why car washes and what types of car washes and why now? So first off, we focus on express tunnel car washes. So you have in bay, which is the kind you park your car and the machine goes around. I actually own one myself here in town. So it's basically a big robot you park, and it just cleans your car, goes around. A lot of these are touchless. Ours is touchless, at least. Some have kind of soft touch type thing. You have full service. So you might pull up to a car wash and a team comes out and washes your car. A version of this is somebody that comes and washes your car at your house, right? Then there's the express tunnel, which is kind of a hybrid. You have some employees there, but you also have a lot of machines that help wash your car. And these are quick. You can go through it in 2, 3, 4, 5 minutes. They're also adjustable. So you can adjust the chemicals, the spray angles, the speed of the conveyor belt. These things take inputs. So you need a team that actually understands what's going on, at least at a high level, because then you can direct your employees to do that. One of the other nice things is a lot of these express tunnel car washes have monthly memberships. And what we like is
Visual
monthly
revenue.
recurring revenue. Exactly. So when you have a business with monthly recurring revenue, then you have a cash flow or an income stream that you can sell at a specific rate, a cap rate, or a multiple of EBITDA in this case. So right now, we're looking at about 15 years before we're kind of fully built out in terms of the express tunnel car washes around the country. And one of the groups that really likes these right now are private equity groups. So if you can buy from a myriad of smaller operators, and 85% of these are owned by smaller operators, you're typically paying around an 8x multiple of EBITDA. So an 8x multiple of that income stream that you're getting. A private equity group for a well-run portfolio of car washes, large portfolio, 50, 100 plus car washes, may pay 50 to 100% higher than that multiple. So there's a ready set of buyers here. So I think there's a window here over the next 5 years. The challenge is who's going to buy them, right? So we talked about private equity. You might have a bigger operator. Well, if you want to sell a portfolio of car washes, you want to have the opportunity to sell without an operating team or with an operating team. So that's what's nice about having basically a modular operating team like we do. We can take a team that's already in place in a wash that we acquire. We can see if they're a good fit for our team. And we typically keep about 50% of the employees that are there on site and incorporate them into our team. One of the nice things is as you fold these into a larger portfolio, there's, as you mentioned, Mike, economies of scale, both at a local level, which means we can do advertising, we can cross market. People really, they like to go to a car wash that's near their house, but it's nice if you have a couple different washes that you can go to. And then also we can leverage regional or national contracts as well. So really the car wash business, aside from people, which we were talking about a little bit earlier with the employees and being able to sell and get people to buy these monthly memberships. The other pieces are chemicals that wash the car. And by the way, these are very environmentally friendly. We recapture almost all of what comes out of the wash before it goes back into the water system. And machines. So we actually have an engineer who has both a mechanical and a chemical background that helps run our team. He's our director of operations. So it's, if you can manage those two pieces of the business, you can hire the right people and you can give a good experience to customers, then they're going to be coming back. Because people that wash their car through an express tunnel car wash, and some of you may be shaking your heads up and down, you don't go because it's the best wash in the world. You go because it's consistent, it's a good value, you know what you're getting. It's kind of like Chick-fil-A, right? I can get a better chicken sandwich somewhere, but I know I'm getting a Chick-fil-A. It's really good. My kids love it. It's predictable. It's quick. I can get in and out. It's a good value. And that's why we go there once a week.
Yeah, that makes a lot of sense. And very quickly, like how big is your operation at this point? Just curious, because I don't know much about the car wash industry. How many locations do you have? Just give us some economy.
Yeah, we have several under contract right now. So we have about 24 that are either currently being operated or in acquisition or construction right now.
Gotcha. So you're basically scaling up. So you're scaling up over the next 5 years.
Absolutely.
And you have 24 and you're trying to get to what?
That's right.
A couple hundred probably to sell it to
between 100 and 200 locations is a nice portfolio size. It's going to give a nice multiple.
Yeah, the same is true. I know a number of folks who do this with the dental practices and veterinary practices. If you get big enough economy of scale, you can get a much bigger multiple versus like a single location trades at a much higher price. And you have a small group, you're paying more per location, and then if you get a whole bunch of them.
That's exactly right. Like Aspen Dental, and my friend works actually for one of the large veterinary advisories. He was one of my roommates in college, and he's an actual veterinarian, but he works with one of these groups. So yeah, it's the exact same thing. If you can build it, run it, and sell it, private equity likes these nice predictable income streams.
Yeah, makes a lot of sense. Obviously, high interest rates have put a kind of thrown a wrench in the wheel for the valuation, because ultimately it's the value of the discounted cash flow. So in this environment, and then they bought them with leverage. It's one of the biggest problems. The leverage has gotten a lot more difficult, a lot more expensive.
Absolutely. Always good to be cognizant of all those things. Absolutely.
So besides challenges acquiring, we'll go back to the multifamily real estate. Besides challenges acquiring, which is going to be the case for the next, I don't know how long, at least a couple of quarters until, I think the story is going to be this, until sellers start capitulating more, until better deals start surfacing.
Or rates come down, right? Or both. Yeah.
I don't know, for the record, it's going to be very hard to see rates drop this year. In fact, Fed is still increasing rates. They're probably not done for another, I don't know, probably they'll be done by the end of this quarter, most likely end of Q1. And with the terminal velocity being between 5 to 5.5 Fed funds rate, that's kind of the consensus on the street.
Yep.
But they've done most of the damage already. I mean, there's a little bit more damage left. So the speculation is how long they're going to keep the rates there, and the general theory is probably until the end of the year, unless problems start occurring, like big problems. So if there are no big problems, because they operate in arrears, they're going to have to see enough data, inflationary data, to come down to the point where they could say, we're done. In fact, they're going to start easing when there are problems. So they won't start easing until they start seeing substantial unemployment and substantial economic challenges. So in this environment, my first question is, any of your existing investments, one of the big problems that I see coming up, all the folks that bought value-add projects, and they bought them with bridge loans, which was the norm. They have maturing paper or rate cap maturity or rate cap expiration, and these loans will renew at a substantially higher rate, like a lot higher rate than the original amount. Are you doing anything about that? Do you have any assets in the portfolio that have this type of a problem, and what can you do?
Yeah, it's a good question. So first off, I think what you can do in the front end is you can align your debt with the hold period of your property, right? And I think a lot of people said, "Hey, let's get a bridge loan, and we'll be okay because look where we are with rental rates increasing, going through this." We either have fixed rate debt or we have debt with rate caps on all of our properties, Mike. So we don't have any of those here maturing in the near future, fortunately. We also have kept our loan to value and our cash on hand at substantial levels. So a loan to value on our portfolio is typically below 70%. We have cash flow in the bank for these properties to give us typically, on average, about 18 to 24 months of runway at very low or no occupancy in these properties. So we got lots of time. If you didn't do that, that's when people are getting into trouble. So what can you do if you're kind of behind the eight ball at that point? We've gotten calls from a lot of groups that are looking to recapitalize and looking to us for help and saying, "Hey, can you come in and do this?" And I think when you mentioned capitulation, I think that's where a lot of this is going to come from, are these groups that, don't have fixed rate debt. They don't have rate caps in place. They're upside down on their cash flows. They're burning through any cash on hand that they have. Or they're going to be forced to refinance. So, for us, we have a lot of properties that are in a really good position, and we're happy to sit and let them cash flow until we're comfortable with the valuation on the other side. But there's going to be a lot of owners and operators out there that aren't going to have that issue. And I think you're going to have to look for potentially help to come in and help bail you out at that point.
Yeah, these are great comments, because you mentioned a few things which kind of come to mind. There are really few ways to solve a problem, and you mentioned one of the ways to solve a problem. So one of the ways, you could do a capital call to existing investors, right? You go back and you ask for capital from folks who already invested. Two, you bring in other investors, and then you mentioned that essentially recapitalize the project. So somebody else comes in with fresh capital and dilutes existing investors because the fresh money is necessary to keep the project afloat.
Yeah.
The third one is a sale. Sale is just an outright, but your recapitalization could be almost like an outright sale. It's maybe not to a full degree, but the fresh money could capture 75% of equity if that's what's necessary to keep the project afloat. So it's good to hear that you don't have any problems like that, but the issue is going to be very common. As you mentioned, some folks already reached out, and I see this exercise being a lot more frequent in the upcoming months because of that maturity. And what's really interesting, on a value-add project, typically, how much do you typically try to push the rents up? So from the time you acquire till the time you believe you have done stabilization value, what's your typical rent increase, average rent?
Yeah, so we're looking at like organic rent increases, like we've underwrote 3-4% typically. On a gross perspective, if our average rent is a couple $1,000s a month for a property, it might be $200. It might be 10% over, a 2 or 3 year period, that sort of thing. Some of the properties that we bought, we've seen, as the rent increases over the past couple of years. 18% in some markets. Our average portfolio is up over 10%. This in 2022 for that. So, again, if you're looking at a couple $1,000s a month, that may be say $200 a month in rent. But I think where people get in trouble is we were seeing a lot of bidders come in, outbid us, and they were assuming 5-6% annualized rent growth, which is pretty substantial in addition to what they're looking to get on a value add component. So that's substantial above what we've seen historically, which is more like 3%.
Well, what's your value add mix? So let's just call it inflation increases at 3 to 4% a year. That's organic. And then to value add, how much additional per year we think value add?
Yeah. So in the first couple years, you may be looking at 10-15% on top of that, 3 to 4%.
So just kind of ending the numbers. So for 2 years at 3 to 4%, you have 6 to 8% plus you get another 15-20%. So you wind up increasing the rents by 26% from the time you acquire till the time you kind of got it stabilized. But the interest rate could have gone up 60% payment factor, 70%, right? If you go
if you're in that position, you're in trouble. Yeah,
it's kind of, you do the math, and we've got deals where the 30-40% rent increases, and those are really strong deals. And you still are lagging behind what these higher interest rates.
We're seeing rates, easy, 200, 300 basis points above. We have some interest rates in the 3% range, and I mean, we're seeing double that now.
Yeah, and that's double effectively. Payment factor doubles. I mean, your debt service doubles. Everything doubles. I said 60, 70, 80%. I didn't even say double, but there are situations where it's double.
Yeah.
So it's kind of a way. It's a pain point for existing and opportunity for new folks to come in, kind of the rescue. Let's switch the subject for another just a couple more minutes. What are the interesting opportunities you're seeing? You also share a little bit about your book and how would folks get a hold of you and just talk a little bit about that.
Yeah, again, I think look, if you've been investing, if we keep saying, hey, we're going to keep doing things the way we've been doing it, then we're probably going to see issues as the landscape changes. And we talked a little bit before the show, Mike, about kind of this, the real estate cycle that's out there and the economic cycles that are out there. But yeah, if you want to get a copy of my book and a little bit more about my background, I go into our overall strategy, nextlevelincome.com. If you click on the book link, if you're in North America, my wife's Canadian, so I'll even send it to Canada here. If you put your address in, I'll send you a free copy.
Thank you for sharing. Appreciate you sharing the book, and it's a pretty cool concept. And I assume you're talking about multifamily, I guess, car wash, and anything else. Just curious, what else?
Yeah, so we do multifamily. This is in order of our asset size. Multifamily, self-storage, car washes. We have a hotel that we were able to acquire in an opportunistic fashion with our hotel operating partner last year. We also do mobile home parks, which I really like. If you look at some of these deeper value add deals as the economic landscape has changed, it's really hard to find affordable housing these days, and mobile home parks can be a really nice option for that. So we have some acquisitions here in Tennessee, North Carolina, South Carolina, the greater Southeast that help fit that need for people here as well.
Yeah, makes sense. And just very briefly, do you do anything in the infinite banking? Just a couple of words on. I know you do a little bit in infinite banking.
Yeah.
So what do you think about?
Yeah. So
what has changed with rising interest rates? Has that strategy changed at all?
Yeah. What's nice is the insurance companies, if you look at the holdings that insurance companies have, and by the way, I'm a licensed life insurance agent. We have a concept called the investment optimizer approach. So if you're a real estate investor and you're interested in applying this strategy, we have a white paper, and we also have a video at our banking page at nextlevelincome.com that talks through this because we won't be able to go through it all right today, Mike. But as interest rates rise, insurance companies, they're buying debt, they're buying treasuries, they're buying real estate, they're making loans on real estate, and the holdings that they have are not just short-term holdings. So they bake in these interest rates, and insurance companies have some of the smartest people out there, actuaries that are out there to line up their debt, their holdings with their obligations on the other side. So one of the nice things is these policies. So if you're talking about the infinite banking concept, what happens is you have a return inside of your policy on the cash value and the cash that you've put into these policies. So if I look back over the past 2 years, my average return in my policies is almost 6% on the cash value in these policies. And that's due to the underlying holdings of the insurance company that's coming. So an insurance company is no different than any other company. They have to pay out their obligations. So they charge their customers, which are their policyholders, a premium. And that premium includes an administration fee. But then they have to do something with their holdings. They have to turn a profit. Well, if you set up these policies the correct way, you're with companies that are called mutual companies. So it's like Vanguard, like a mutual fund company, a true mutual company. And what that means is, let's say the business turns a 1 or 2% profit every year. So if they guarantee a 4% rate, they're going to send you another 1 or 2% on top of that guaranteed rate of return that they've made as a profit, and that gets distributed to the policyholders, which is really nice. What's great if you're an investor like we are and you're listening today, you can access that cash value. So let's say your cost of capital is 5%, 6%, then you can go and invest that money somewhere else and get a higher rate of return. And now it's compounding inside of your policies. The company, if it's set up with the right company, treats it like it's untouched, and you can invest that money elsewhere as well. So you get the benefits inside of the policy. And I wouldn't really call that an investment, but it's a tool, right? Because you get the insurance that you're paying for inside of this, and you get to use your cash in a true investment, a cash flow investment. And then you can obviously determine, hey, is it worth it for me to borrow at 5 or 6% to invest elsewhere? And if you say, well, I can just pay nothing and use my cash that's in the bank, that's a fallacious argument, because there's always a cost of capital that's out there. So what's nice is using this strategy also keeps you honest, because just like any good business owner or any CEO will tell you, there's a cost of capital. And that's how, Mike, you mentioned, net present value. That's how you calculate that, right? Is you say, okay, how are we discounting this back to zero? And you have to have a cost of capital that's associated with that. So I like it from a kind of a wonky financial perspective. Again, if you want to dive really deep into it, if you want to see how we use it in the investment optimizer approach, you can check out nextlevelincome.com and click on the banking section there.
Yeah, Chris, I appreciate you sharing that. And one of the things that I really like about infinite banking, and I use it too, is the simple fact that cash in the bank doesn't really earn you as much. Although with rising interest rates, it start earning some interest. But you can earn more within a policy. And the biggest strength of this approach is the fact that you have access to cash. You could borrow against your policy at any moment of time. That access to liquidity is more important than having cash in the bank. So that's a very powerful instrument where you effectively have a true insurance policy, God forbid something happens, but you also have substantial access to cash if the policy is structured properly. And when you're waiting for better opportunities, it's better to sit on a policy like this than sit on cash, because cash doesn't earn you the same level of return as the policy does. And when you get a great opportunity and you could borrow against the policy and deploy it in the right deal, that creates that kind of optimization of cash planning in a matter of speaking. Yeah. So appreciate your sharing.
I love it. Yeah.
Yeah, and obviously you are the licensed insurance agent, and you got great use case scenarios on your website. So nextlevelincome.com, right?
Yes, sir. Absolutely.
Appreciate you coming on the podcast. And any final words, any thoughts, any good book, anything? And we got to wrap up. It's a great episode. Appreciate you coming on the podcast.
Yeah, no, we got to wrap up. So I'll tell you what, I mentioned the 18.5-year real estate cycle. This book, The Secret Life of Real Estate and Banking by Phil Anderson, is a great read. It'll talk about the cycles in real estate going back into the 1850s in the United States. And it really ties together. I was reading Ray Dalio yesterday, he talked about 7-year cycle, and then 4-year cycle. Add those up, 18-year cycles. So take a look at that book if you're interested. You can learn a little bit more about that as well.
Thank you for sharing. Thank you for your wisdom. Appreciate you being a guest on the podcast.
Mike, thanks for the opportunity. Happy New Year, my friend.
Happy New Year.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot dig. Keep listening and keep investing Big Mike style. See you on the next episode.